$600 billion. That was the size of Lehman Brothers when it collapsed. For more than 150 years, Lehman was one of the biggest names on Wall Street. It looked powerful. It looked permanent. It looked too big to fail. Then in September 2008, it imploded. And when Lehman fell, the panic spread everywhere. Markets froze. Trust disappeared. And the financial system started breaking in real time. So how did a 158-year-old investment bank collapse so fast? What were they hiding? And why did nobody stop it before it was too late? This is the story of Lehman Brothers. Lehman Brothers started as a small business in the 1800s. Over time, it grew into a giant financial institution. By the 2000s, it was deeply tied to the mortgage boom in the United States. And that boom looked unstoppable. Home prices kept rising. Banks kept lending. Wall Street kept packaging mortgages into complex securities. Everyone was making money. Or at least it looked that way. Lehman wanted more of that money. A lot more. So the firm loaded up on real estate and mortgage-related assets. It made aggressive bets on housing. It bought into the idea that the housing market would stay strong. And as the years went on, Lehman became more exposed. That exposure was dangerous. But during the boom, danger is easy to ignore. As long as prices keep rising, bad decisions can look smart. As long as deals keep closing, leverage can look efficient. As long as profits keep showing up, people stop asking hard questions. Lehman leaned into that environment. The firm borrowed heavily. It used leverage to magnify returns. That made the upside look bigger. But it also made the downside much more deadly. This is one of the key lessons of financial collapse. Leverage makes everything look better on the way up. Then it destroys you on the way down. Lehman was not just participating in the housing boom. It was deeply built around it. And when the housing market started cracking, Lehman's foundation started cracking too. By 2007, the mortgage market was getting ugly. Subprime loans were going bad. Defaults were rising. The value of mortgage-linked assets was getting harder to trust. That was the real problem. Not just that losses existed, but that nobody fully knew how bad those losses were. And once trust starts disappearing in finance, everything changes. Because large financial firms do not run on cash sitting safely in a vault. They run on confidence. Confidence from lenders. Confidence from counterparties. Confidence from the market. If people stop trusting your balance sheet, your survival clock starts ticking. Lehman should have been reducing risk. It should have been shrinking exposure. It should have been preparing for a brutal downturn. Instead, it kept trying to hold the image together. The firm reported numbers that suggested strength. Executives projected confidence. Publicly, the message was that Lehman was managing through the storm. But behind the scenes, pressure was building. One of the most controversial parts of the Lehman story was a maneuver called Repo 105. Here is the simple version. Lehman used short-term transactions to temporarily move assets off its balance sheet right before reporting periods. That made its leverage look lower than it really was. Then after the reporting period, the assets came back. In plain English, it was like cleaning up the room for inspection, then putting all the mess back after the inspector left. That mattered because investors, regulators, and the market were looking at those numbers to judge risk. And if the picture looked cleaner than reality, then people were not seeing the true danger. This is why Lehman became such a famous collapse. It was not just bad bets. It was also about how the firm managed appearances while the real risk kept growing. Now, to be clear, Lehman was not the only firm exposed to toxic mortgage assets. The whole system had problems. Banks, investors, and rating agencies all played a role in building the bubble. But Lehman stood out because it was so fragile when confidence finally broke. And in a crisis, fragile firms do not get much time. In March 2008, Bear Stearns collapsed and had to be rescued. That should have been a giant warning sign. It showed that a major Wall Street firm could fail fast when funding dried up. Lehman was still standing, but the pressure on it was growing. Investors were watching closely. Analysts were asking harder questions. Counterparties were becoming nervous. The stock started falling, and falling, and falling. That is another pattern in big collapses. Once the market believes you may be in trouble, the trouble gets worse. A falling stock price hurts confidence. Lower confidence makes funding harder. Harder funding makes survival harder. And the spiral tightens. Lehman tried to find solutions. It looked for buyers. It explored deals. There were discussions with government officials and other financial players. But no rescue came together in time. And that decision changed history. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history at the time. Think about how shocking that was. A firm that had survived wars, recessions, and generations of market turmoil was suddenly gone. One of the most famous names on Wall Street had collapsed. And the system did not take it calmly. The failure sent fear everywhere. Money market funds were hit. Credit markets tightened. Banks became more afraid to lend. Investors rushed to safety. The global financial system started seizing up. This is the part many people miss. Lehman's collapse was not just one company dying. It was a signal flare telling the world that trust inside the financial system was breaking. And when trust breaks in finance, panic spreads faster than most people realize. Businesses could not get funding normally. Markets became unstable. Retirement accounts got hit. Jobs disappeared. Families suffered. The damage did not stay on Wall Street. That is why Lehman matters so much. Its collapse became one of the defining moments of the 2008 financial crisis. Now let's talk about the deeper mechanism. Lehman did not collapse in one day because of one bad trade. It collapsed because multiple layers of weakness stacked on top of each other. First, massive exposure to mortgage-related assets. Second, heavy leverage. Third, declining asset values. Fourth, growing doubts about transparency. Fifth, dependence on confidence and short-term funding. That combination is deadly. If your assets are falling, your debt is high, your funding is fragile, and people no longer trust your numbers, you are in a death zone. Lehman entered that zone. And once it did, recovery became incredibly hard. There is also a psychological lesson here. During the boom, people confuse momentum with safety. They think, it is big, so it must be stable. It is profitable, so it must be smart. It has been around forever, so it must survive. But history keeps teaching the same lesson. Size is not safety. Prestige is not safety. Age is not safety. If the underlying structure is weak, collapse can still happen. That is what made Lehman so terrifying. It exposed how weak the system really was beneath the image of sophistication. And that is why 2008 still matters today. Because the Lehman story is not just about one company. It is about leverage, hidden fragility, bad incentives, and what happens when trust evaporates. It is also about how quickly things can unravel when everyone depends on everyone else. Modern finance is deeply connected. Banks lend to banks. Funds depend on banks. Businesses depend on credit. Consumers depend on functioning markets. So when one major player breaks in the wrong way, the damage can cascade. Lehman became the symbol of that cascade. For regular people, the lesson is simple. Do not be fooled by surface strength. Big institutions can be fragile. Complicated financial products can hide ugly risk. And when too much of a system is built on debt and confidence, the system can snap. For builders, investors, and leaders, The lesson is even sharper. Do not build a structure that only works in perfect weather, because sooner or later, the weather changes. Lehman was built for the boom. When the storm arrived, the structure could not hold. And once the truth became visible, it was over. A 158-year-old Wall Street giant, $600 billion in assets, one of the most famous names in finance, gone. That is why Lehman Brothers remains one of the most important corporate collapse stories ever. It was not just a bankruptcy. It was a warning about leverage, a warning about appearances, a warning about hidden risk, and a warning that systems built on fragile foundations can look powerful right up until the moment they fail. Lehman Brothers did not just collapse. It helped reveal how close the entire financial system was to breaking. And once people saw that, panic took over. That is the real story of Lehman Brothers. If you want more breakdowns on corporate collapse, fraud, and financial disasters, subscribe. And if you want the next case, watch the next video. Because the biggest failures usually leave the clearest lessons.